Hello, everyone. Welcome to the weekly roundup. Today we'll cover interest rates, growth, and market sentiments. Hello, Ben.
Hi, Eva.
It's hot, hot out there. I
Summertime.
mean, it's not even, is it summer yet, though?
I guess not. Another, what, 16 days till we are officially in summer?
Oh, it's gonna be a hot one this year.
I hope so.
No.
I think you're not alone there. I think a lot of people like a nice cool summer.
Yes, exactly. Like, just be in between. Like, give us maybe between 20 and 25. Anything over 25, no.
Yeah, for sure.
Okay, let's get right into it. We'll start off with the Bank of Canada. They held rates steady yesterday.
Yeah.
This was largely in line with market expectations, but was there anything that stood out in the statement? And also, do we think that, a rate cut is on the table for the next meeting?
Mm. Yeah, so it's a great question and it's a great point. I mean, we've had so many swings in what will happen with rates this year. I think as many swings as I can remember, where a few weeks ago we were expecting cut in June, and that evaporated after the core CPI, as you mentioned last week, went up above that 3% level. So Bank of Canada has that band 1 to 3%. Anything inside of that they're comfortable with, but we were at 3.2% on core CPI, but CPI itself was at 1.7, but the reason we didn't raise effectively what they said is they're concerned about inflation. So we still anticipate rate cuts this year, and I think the other reasons or you can read into what the Bank of Canada said effectively though, is they're concerned about what's going on with the economy and what's happening with trades and tariff. There's a pretty reasonable breakdown just looking at which provinces have been the most impacted, but generally speaking, the economy continues to slow based on these trade and tariff war that's going on between Canada and the US and the rest of the world with the US, of course, but that's another subject. But with the view that Bank Canada continues to look at the economy slowing, that's why they started cutting last year. It looks like it continues to slow. And so the view is still that rates come down and, inflation is something causing them some concern. We'll see how much of an impact that has medium term.
Yep. Speaking on growth, the OECD revised its global growth forecast downwards to 2.9% for 2025. They cited trade tensions and inflation. Did the market react to this downgrade, or was it already priced in?
Say generally it was priced in. Obviously, the headline is concerning, but I'd say it's generally priced in. It's an interesting point that we've reached, of course, like what and how much of an impact is this trade war going to have on the world? How quickly is it going to come into place? Um, how much can be priced in too, because we haven't had a trade tariff war in, 50 years probably. So the market doesn't really know what to do with it. But the question I keep asking myself is, you know, everybody knows the economy is slowing.
Yeah.
Why are the markets trading the way they are? Is there something else that is unseen to the average eye at this point? So the answer is the global economy is slowing. I guess the world knows that. I guess they're okay with valuations at this point. But certainly it's a pretty material concerns for me is the economy slowing. So at what point does the market care?
Yeah. So now that we're in a new month, how
Hmm.
about we do a quick May market recap? At a high level, also, what are we watching in June?
Mhm.
We're approaching the end of the first half of the year. So what
Yep.
should we be looking out for?
Well, obviously, as we went through April, April was a terrible month and pretty much everything risk related. Obviously, we bounced into the end of April, so it wasn't nearly what it was in the middle of April. But on the back of that, we saw really a complete bounce back to the upside. And so you saw broad markets rally. You saw pretty much every risk asset in the world rally off of the middle of April lows. So May was a good month. And whether you owned, tech or small cap or um, precious metals or the miners as well, everything really moved up off of the bottom. And so I'd say May was a good month, and if you were a little bit tilted towards, I'd say, precious metals, base metals, you actually did a little. You had some outperformance over the balanced index. So, as we track all these indices, balanced index was probably up below 2% year to date. But if you had a little bit of tilt towards some of the base precious metals, you probably had a 1 to 2% upside on top of that. So more like a 3-4% return by the end of May. So yeah, it was a good month, and as we get into June now, I start to say what happens from here. And to your point, and I know you maybe will ask me about sentiment in a minute, but sentiment is continuing to be quite positive. So that also causes you a bit of concern as sentiment's optimistic and economic data is terrible. So what's going on there? You get a bit of a mismatch. And so we'd be a bit cautious coming into June. But precious metals and the mining companies continued to be positive performers year to date and materially so in some cases. So, I read a lot of articles with a lot of optimism around gold and silver, which start to cause me some concern that there's not a lot of counter arguments right now, which is a reasonable contrarian signal in my brain that says you need to pay attention.
Yeah,
Yeah.
absolutely.
Yep.
Let's see the charts.
Okay. All right, just let me know if you can see those.
Yes, again.
Okay, perfect. So we're recording this on Thursday, June 5th. Put this together yesterday. So Thursday, June 5th, and anything that happens after the 1 o'clock, we're not necessarily going to comment on. But this Eva does comment a little bit around what happened in April and then what happened in May. And so as we reach that Liberation Day, this is a two-parter. Of course, the top of this is the economic, so recession probabilities, versus the bottom is the S&P 500. And so we saw pretty material concern about a recession move up significantly. Even if we strip this chart back many, many years, you wouldn't see a jump like this. And then you pair it with the drawdown in the S&P, which we got to close to 20% downside in the S&P, finishing into end of May as fairly neutral, where you start to see recession probability falling, which again for me is probably counterintuitive because it looks like recessionary probabilities increase every month that we continue with this trade tariff war. But it just shows you how quickly these announcements concern market sell off, and then we close the gap in a really extremely short period of time, which historically has been bear market signals. So certainly something to be cautious and conscious about. As we sit and look at the headlines, I think it's worthwhile to just have a think a little bit around all the things that the United States are trying to do right now. Obviously, I don't like the strategy tactics per se, but the U.S. charges relatively little taxes, and so this is sales tax of the G7 plus China. So where part of the reason why you want to go to the United States is so that you don't pay this type of tax. But right now, effectively, U.S. charges 0% sales tax, with Italy, UK, France, Germany, China, Japan, and then Canada, of course, would be on the list of the taxes they pay. So, I think there's something to be said about what they're trying to accomplish with their trade and tariffs, is they're trying to generate more revenue without pulling it from the pocket of the consumer. Ultimately, it is going to come from the consumer's pocket. So maybe the US government does consider sales tax. And so if you looked at a sales tax, obviously even a 1 or 2% increase in sales tax is a material revenue increase for the US. So something to think about just as some of the potential outcomes about where they may look to generate additional revenue. They'll never make enough money to offset the debt levels they have, but certainly if they're looking to attract more revenue, that's one source of income that they could increase. And so this is a little bit on sentiment and positioning, just thinking about what the market's thinking about, what's going to do well versus what's doing poorly. And so I always look at these as the signals for how optimistic current positions are versus how pessimistic. And it certainly plays a part in how much certain areas can swing. So if we look up in this top category, you're looking at the S&P 500. You're looking at net positioning, so pretty neutral here. So this is zero level, shows you people are kind of, yeah, we're okay with the levels of the S&P right now. We're not bullish, we're not bearish, we're just kind of neutral. We're kind of waiting and seeing what could potentially happen. Or if you scream down here to the 5-year US, you get a -2 Z-score. This is a huge bearish positioning. And so the institutional investors will say are betting on the fact that the 5-year US bond yield will keep going up and price going down. And so why this is relevant is just when you're thinking about buying certain areas, if you like where the 5-year US bond is trading at, then you'd look at it and say, am I comfortable with the coupon I'm going to get, which is at about 4% right now? You can buy a 5-year at 4%, with also the view that the market's positioned negatively on this. If we start to see some momentum shift to the other side where people want to buy bonds again, then you get these speculators that are short, they're going to have to cover. And so that's where you get big rallies in certain areas. So when you get these big minus positions and then there's a turn to the positive on the news of what you're buying, that ends up resulting in potential alpha positioning. So even if you look down into gold, which I mentioned, gold's had a good run here, but you're still looking at a little bit of negative sentiment around gold. And so that's an interesting piece and call out that I'd pay attention to. But this is always a great chart to look at. And as the world looks at, like I'd say the last piece that I'll comment on this page, which is yen versus US dollar. Yen has had a nice move here versus US dollar. And so that, you're probably longer in the tooth in that trade. That trade's probably worked for you quite well. If you owned it, now would probably be a reasonable time for you to consider saying, maybe I should take some profits on it. So I've had a number of conversations just around different areas, but uranium's been grabbing a lot more attention. We saw some big moves in the spot price of uranium, and with the fact that President Trump was talking a little bit about restarting nuclear reactors and increasing nuclear power and energy and things like that. And if you look around the world globally, that continues to be the story as well. But this chart here is multi-pronged, so this would be Cameco. So Cameco would be the purple line here, and the red line here would be the Sprott Uranium Trust. So that would effectively be the commodity that you'd have exposure to. So this is from our technical analysis team, but effectively they're saying here, you've had the commodity correct and stay down and not rally to the upside, where we've had Cameco, the purple line, rally materially above where the commodity was trading, likely downside. If you can see here, they say, at being similar negative divergence. So they believe that there's some significant downside with Cameco and likely with uranium, at least temporarily here as well. So if you're a technician, when you see the numbers start to roll over like this, you start to think about either one, taking profits or finding a way to build in some protection into your portfolio. So I thought an interesting chart. I do think it's going to be worth paying attention to see what happens with nuclear and uranium. as the world continues to look for additional electricity to support all of the initiatives that they're putting into place, particularly around AI and cloud and so on and so forth. As always, the opinions expressed do not necessarily reflect those of National Bank Financial. Should you have any questions or thoughts or want to discuss any of the things we talk about today, either speak with your advisor or speak with me, and happy to answer and address any of your questions at that point.
Great. Thank you, Ben.
You're welcome.
So what's on the agenda for next week?
Yep, we will see where the market continues to progress from here. The focus really is on the big, beautiful bill that's being worked on in the United States right now with a target date of 4th of July. So they are, or at least President Trump and his team have said that they want to have something done and dusted in place before the U.S. Independence Day, which is the 4th of July. So I'd say a lot of attention will go towards that. What are they working on? How are they going to progress? Um, We've seen volatility continuing to go sideways to down. The market's been kind of in a quieter range right now, gotten through most of earnings season. So I think that's where it'd be focused. We've seen a bit of an increase in military activity in the Ukraine and Russia, so that'll be worth watching and paying attention to as well, as a potential risk out there. But from a pure economic macro perspective, we'll continue to watch the the inflation and growth numbers, and then see how things progress from here. So that'd be the focus, seeing what happens. Took some profits in May for clients, and so we'd be cautiously waiting to see what we need to do for next action.
Yeah, sounds good.
Excellent.
Okay, thank you again. For everyone, remember to visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group. As always, the link to our daily financial heartbeats will be in the caption of the video and will be in your email as well. For our clients, please reach out to me if you have any questions or if you'd like to book a portfolio review meeting with Ben. Thank you for listening and have a great weekend after you get through Friday.
Yeah, exactly. Thanks. Thank you, everybody.
Bye.
Take care. Bye.